We are currently witnessing a massive divergence between institutional accumulation patterns and retail sentiment at the $75,000 mark. Most market participants are celebrating this price level as a victory, but the on-chain data suggests a far more complex and dangerous scenario is unfolding behind the scenes. If you are currently holding a significant position in Bitcoin, or if you are considering leveraging into this rally, you are standing on very thin ice without realizing it. The order books on major exchanges are showing a liquidity vacuum that typically precedes a violent volatility flush, designed to liquidate over-leveraged long positions. You need to understand that smart money does not buy when the crowd is euphoric. They sell into the strength or they hedge their downside risk while you are left exposed. In the next few minutes, I am going to walk you through the specific on-chain metrics and derivative market signals that differentiate a true breakout from a classic bull trap. I will show you exactly why the $75,000 level is the most critical pivot point we have faced since the late 2020 cycle. Let us get into the weeds of what is actually happening with the supply dynamics of Bitcoin right now. The first thing we need to address is the realization of profits by short-term holders who bought the bottom of the recent correction. When we look at the spent output profit ratio for coins younger than 155 days, we see a spike that indicates aggressive selling pressure from retail traders. This creates a natural ceiling for the price, as every attempt to push higher is met with a wall of sell orders from people eager to secure a quick gain. However, the reality is that this selling pressure is being absorbed almost instantly, which brings us to the most important metric of this cycle. We are seeing a historic decoupling between price action and exchange reserves. The total balance of Bitcoin held on centralized trading platforms has hit a 3-year low, creating a supply shock that is fundamentally different from previous market tops. In past cycles, as we approached all-time highs, we typically saw inflows to exchanges as whales prepared to dump their bags on retail buyers. Today, we are seeing the exact opposite, with net outflows continuing even as the price hovers around $75,000. Here's why this matters for your portfolio and your immediate trading strategy. If the supply on exchanges is dwindling, it means the liquid inventory available for purchase is becoming incredibly scarce. This suggests that the smart money is not positioning for a sell-off, but rather they are moving their assets into cold storage for a much longer time horizon. This behavior aligns perfectly with the flows we are tracking from the spot exchange-traded funds in the United States. While the headlines focus on the daily price fluctuations, the institutional-grade funds are quietly scooping up more Bitcoin than the miners can produce on a daily basis. This creates a mathematical imbalance that must eventually resolve to the upside, provided we do not face a macroeconomic black swan event. However, we must remain objective and look at the bearish case to ensure we are not falling victim to confirmation bias. The derivatives market is currently flashing a warning signal that we cannot afford to ignore. Open interest in Bitcoin futures has reached a level that has historically coincided with local market tops. When open interest gets this high, it implies that there is an excessive amount of leverage in the system. The funding rates are currently positive, which means that traders with long positions are paying a premium to traders with short positions just to keep their trades open. This dynamic creates an incentive for market makers to push the price down to liquidate those long positions and capture the liquidity. It is a classic washout scenario that we have seen time and time again. If we see a sudden drop to the $68,000 region, do not be surprised, as it would simply be the market resetting the leverage before the next leg up. If this level of detailed analysis helps you navigate the noise of the market, consider joining our community of serious investors by subscribing to the channel for daily updates. Now, I want to pivot to the macroeconomic landscape, because Bitcoin does not exist in a vacuum. We are currently in a phase where global liquidity is beginning to expand again after a long period of tightening by central banks. The M2 money supply growth in major economies is turning positive, and historically, Bitcoin has been the fastest horse in the race during periods of liquidity expansion. The correlation between Bitcoin and the S&P 500 has been tightening, suggesting that Wall Street views this asset as a high beta technology play rather than just a digital gold hedge. This is a double-edged sword because it means that if the traditional stock market corrects due to recession fears, Bitcoin will likely follow suit in the short term. However, the reality is that the long-term structural demand for a sovereign store of value has never been higher. We are seeing nation-states and sovereign wealth funds beginning to publicly discuss the inclusion of Bitcoin in their treasuries. This is the game theory playing out exactly as predicted, but at a much faster pace than anyone anticipated. Let us look at the behavior of the miners, who are the natural sellers in this ecosystem. Following the recent halving event, miner revenue was slashed in half, forcing inefficient operations to shut down or sell their treasury holdings to cover operational costs. We have now passed the capitulation phase where miners were forced sellers. The hash rate has stabilized and is reaching new all-time highs, indicating that the remaining miners are profitable and expanding their operations. This removes a significant source of constant selling pressure from the market. When you combine the lack of miner selling with the massive institutional demand, the supply side of the equation looks incredibly bullish. But we must return to the immediate price action at $75,000. Is this a trap? The answer lies in the volume profile of the current trading range. We are building a massive base of support at these levels, which is healthy for the longevity of the trend. A parabolic move straight to $100,000 would actually be unhealthy and likely result in a catastrophic crash shortly after. What we want to see is a slow grind higher, with periods of consolidation that allow the moving averages to catch up to the price. This allows capital to rotate from Bitcoin into Ethereum and other high-cap assets, and then back into Bitcoin, sustaining the cycle. If you are looking for a clear signal to enter or exit, you need to watch the realized price of the short-term holder cohort. Currently, that realized price is sitting significantly lower than the current market price, which provides a strong support band in case of a correction. As long as the price stays above the cost basis of the short-term holders, the trend remains bullish. If we break below that level, it signals that recent buyers are underwater and may panic sell, triggering a cascade. This is the nuance that most social media influencers will never tell you because it is not exciting. They sell you the dream of infinite upside, but my job is to protect your capital. If you appreciate an honest and risk-focused approach to the markets, make sure to like this video so we can keep providing you with this data. Let us discuss the psychological aspect of the $75,000 level. Humans are wired to take profits at round numbers, and $75,000 acts as a massive psychological barrier. We are seeing a large wall of limit sell orders stacked at this price on every major exchange. For us to break through this, we need a catalyst that drives fresh retail volume into the market. Right now, retail interest as measured by Google Trends and App Store downloads is still surprisingly low compared to previous cycles. This is actually a very bullish signal. It means that the price has reached all-time highs purely on institutional demand, without the mania of the retail crowd. Imagine what happens when the retail crowd finally wakes up and realizes that Bitcoin is trading at $80,000 or $90,000. That is when the vertical phase of the market cycle typically begins. Therefore, characterizing the current price action as a bear trap seems fundamentally flawed when you look at the composition of the buyers. Institutions do not buy bear traps. They buy assets with a 5 to 10-year time horizon. The volatility we are seeing is simply noise within a much larger structural uptrend. However, you must be prepared for the possibility of a 20 to 30% correction at any moment. In a bull market, these corrections are features, not bugs. They serve to shake out the weak hands and transfer coins to those with higher conviction. So, what is the playbook for navigating this specific moment in time? If you are a long-term investor, you should view any dip below $70,000 as a gift and an opportunity to accumulate more. If you are a trader, you must be extremely cautious with leverage right now because the market is hunting for your liquidation price. The smart play is to reduce your leverage and spot long the asset, removing the risk of being wicked out of your position. Do not try to time the exact top, because in a liquidity-driven bull run, the price can remain irrational far longer than you can remain solvent. Focus on the trend of the 200-week moving average, which continues to slope upwards. The reality is that we are likely in the early to middle stages of the cycle, not the end. The supply shock from the halving has not fully hit the market yet, as there is typically a delay of 6 to 12 months before the full effect is felt. We are currently sitting right in that sweet spot where the supply shock meets increasing demand. To summarize the situation, while the $75,000 level feels precarious, the underlying data supports a continuation of the rally. The exchange reserves are low, miner selling has exhausted, and institutional inflows are persistent. The only bearish factor is the overheated derivatives market, which may need to be flushed out before we can proceed higher. Do not let a short-term volatility flush scare you out of a long-term generational position. Stay focused on the on-chain data and ignore the emotional noise on social media. Please remember that everything discussed here is for educational purposes only and does not constitute financial advice. You must always do your own research and consult with a certified financial professional before making any investment decisions. The market is unforgiving, but for those who are prepared, It offers the greatest opportunity of our lifetime.